And we are recording. And we are now live. Good morning, everyone. Dean DeTonencourt here, President and CEO of HomeSmart Professionals Real Estate. And I am excited to be joined by Melissa Delana this morning. Melissa Delana of Delana Law. Good morning, Melissa.
Good morning, Dean. Thank you for having me, and thank you for everybody for tuning in to hear this much needed conversation.
Absolutely. No, I appreciate that. And I'm excited to dig into the follow-up to our conversation that led us to this point, right? So I do want to start with, of course, mentioning that we do have the Q&A panel open. If anyone has a question, please put that in the chat box, or I'm sorry, in the Q&A box, so that we can watch that. I will be monitoring that as Melissa is discussing the details. And if you see a question that you like in that Q&A, click on it. It will accentuate any of the questions that are more pertinent. So we'll be watching that. And Melissa, in advance, I'll ask permission to interrupt you as topics come up and as questions come up, and I'll save some questions when they're appropriate. So, but ultimately we're here to share all of the details. Of course, I'd be remiss if I didn't introduce Melissa. For those who haven't had the pleasure of working with Melissa and her firm, I do want to give a brief introduction so you know the caliber of the person we're learning from today. So Melissa Delana is a partner at the Delana Law Office located in East Greenwich, Rhode Island. She's been practicing at her family firm with her father, Carmen Delana, since 2004 after attending Roger Williams Law School. Her practice as a title attorney covers all aspects of real estate conveyancing. Melissa is a member of the Rhode Island and Massachusetts Bar Associations and has strong interest in education. Melissa's been an instructor for the Rhode Island Association, as well as maintaining her own real estate approved school, where she educates agents about ongoing issues for continuing education credit. And Melissa is a native of Rhode Island and resides in East Greenwich with her husband and two sons. So thank you again, Melissa. And we are going to dig right in, okay? So I want to just, refresh. When we were having our conversation about the CD and all things that come along with the CD, there is the need for understanding when it comes to, in our world as real estate practitioners, we need to understand that CD, the closing disclosure, the HUD settlement form, whatever the ALTA statement, and we'll look at all of them. When it comes down to it, whatever closing statements affect our clients at the closing table, we need to understand them. We need to be reviewing them. We need to be explaining them to our clients. Now, those are big words right there, right? Because ultimately we think the attorney or settlement agent is explaining it to the clients. We need to be able to understand what's on that form and not take details for granted when it comes to anything that's in any numbers that are there. So today, our hope is that we're going to be able to break that down and show you what's important to you as a real estate practitioner in being able to answer your clients' questions. Now, we're going to rely on the closing agent to do the talking and the explanation, but you will have questions. And there are certain parts that affect you personally as the real estate practitioner when it comes down to your brokerage fee in every transaction. And we're going to hit on that as well. So here we're trying to just solve some of the confusions, but more importantly, make sure that you understand what these documents look like, what should be on them, and how you can answer questions for your clients as well. So Melissa, referring back to that conversation, I just wanted to make sure that our audience knows ultimately what we're trying to accomplish here today.
Yeah, Dean, and a huge thank you to you, because I know we started this conversation several months ago about, especially during the troubled and difficult times we're having, with the challenges that are facing these agents, and that this is a much needed conversation, not only as a refresher, but in some instances, maybe a first conversation, especially as it pertains to the COVID closings, which we're going to touch on briefly. So I really want to give you my sincere thanks and your team for putting together this marketing information and platforming this so that we have the opportunity to discuss it with agents in an effort really to try to help you help your clients, because that's what it's truly all about. You may or may not feel comfortable reviewing a closing disclosure or a HUD or a settlement statement with your clients. While that may not be your role, you do need to understand it. So I'm hoping this class will help, clear up some of those questions you may have.
everyone's going to walk away with just a little bit of information, right? So,
That's the goal.
the key is in the takeaway. So,
I'm
so
excited.
yeah, so thank you again. So how should we begin? What's the best way to give an overview of what we want to know and, and dig in?
So I want to just sideline for a minute and kind of deal with the closings during COVID, because that is something that is very much a pressing issue. Although that is not the focus of this conversation, I think it's useful to just remember that many attorneys are not actually inviting agents to be in attendance of closings right now, which is making it very uncomfortable, not only for the agents, the brokers, the attorneys, but also the clients, which again, this is really all about the clients. So I want to make sure that you recognize that we as attorneys are still very much aware you are such a crucially important part of the closing transaction and in allowing us to get to that place. So even though you may not be able to attend, again, the expectation is you should have an opportunity to review these documents in advance of the closing. And I understand it is more challenging now because we are facing more challenges. The volume that the lenders are dealing with, the volume that us as the attorneys are dealing with are challenging. So you may not be getting the information 3 days in advance or even an hour before the closing, because we may not be getting that information that far in advance. But really, it's important that you're talking with your closing attorney partners, the seller's attorney if you're representing a seller, and your respective clients about what documents they're seeing so that you as the agent have an opportunity to review them as well, if not in person, in advance. And certainly, as a side note, fast forwarding to after the closing, we know you all need the settlement statement, which is that final accounting to prove that the closing took place. You're not going to be compensated by your brokerage if you haven't received a fully signed ALTA or settlement statement or CD. We all know it. The struggle is that the way that closings are taking place right now are really bifurcated, right? So buyers and sellers are not assembling. I don't have all of the documents signed at once so that I can disseminate the checks and the copies at the same time. By and large, we are making it our practice, as I think many attorneys are, to share the signed documents once they've been signed by all parties and once the closing is fully funded, meaning that the monies have arrived and basically we're at a point of recording. Even that, it's not a rabbit hole I want to go down, but the way that recordings are happening are different. So you're getting sort of a "it's done" email. And when it's done is when you're getting the settlement statement. So if the closing's at 1 o'clock and you email me saying I need a settlement statement, I don't have it to give you. You may not get it until the next day or later in the evening, because again, we have to get it worked out. But understand, every attorney out there knows you need this, and we're working diligently to try to get it to you after.
Thank you for that clarification. And I want to say also, getting a copy of it, like you said, as real estate professionals, we need copies to confirm that our side of the transaction closed, right? So ultimately, we assume that if one side closes, both sides have closed, but with split closings these days, it's very difficult to confirm that if people going in at different times. So ultimately, I think every licensee needs to remember that your brokerage does need something confirming that this closing took place. And there are some of these forms that are confidential in nature, and you may not be able to get copies of certain things. That there's a reason that things are confidential, which includes us. But we can ask permission to receive copies, and we can request them. Even the sales agreement allows you to obtain certain copies. So be mindful that, I'm just speaking as a broker here, your broker will need a copy of something to show that it closed. And if people aren't cooperating and giving you copies, you need to request that permission in order to get that copy. So get that permission from your client right up front.
Yeah, and you mentioned the separate closings. Just wanted to side note that if you are representing a seller as a listing agent, more and more sellers are electing to have representation and sellers counsel. Generally speaking, as far as setting the expectations for when will they be closing, it's not usually the day of the closing as prescribed in the sales agreement. Most attorneys, myself included, will attempt to meet with the sellers at least 1 to 2 days in advance of the scheduled closing, so that the seller side is done and worked out, so that we can have the original documents delivered to the closing attorney, so that when they sit down with the buyers, you have one fully executed set of versions of documents. Now, again, time, schedules, life challenges don't always permit that to happen. But in a perfect world, sellers are not generally signing on the day of closing unless they don't have an attorney, in which case they're meeting with the closing attorney and it just kind of gets worked into the schedule. So make sure you're sort of setting that expectation for your clients as agents.
Thank you. And I'm going to allow you to lead into this because I know that it's part of our upfront explanation, but we did receive a question in the chat box, and everyone also please watch, throw questions in the Q&A for us rather than the chat. But there is a question that did come up asking the difference between a CD, an ALTA, and a HUD. And with regard to that question, I promise that we're going to be breaking that down for you. So I appreciate the question.
Come to the right place.
Yes, that's exactly right. So, we will be breaking that down as we go.
So the goals of today really are to be discussing the various types of documents, which are really truly the final accountings of our transactions. So you have been quarterbacking this transaction from the onset of when the sales agreement was drafted. This is the final hurrah. And it's a shared disclosure, right? The ALTA settlement statement is a shared disclosure. That document will include, as all the documents, the sales prices, the payments of the debts and the liens, the municipal prorations for the real estate taxes, fire district, water bills, commissions, right? We want to make sure we're accounting for those and closing costs. The closing disclosure itself, which is really where we're going to start today, I use settlement statement kind of interchangeably because that could either be referring to a HUD or an ALTA or kind of the combination of those disclosures.
That's helpful.
But we will go through what each individual document is, what it means, what it looks like. So you will have a mastery of what the differences are. So thank you for your question.
Yes, and if I may, just, again, just to clarify, in our world, I'm just going to help with that. If you think along the lines of this, the CD is specific to the client, right? So it's either a buyer CD or a seller CD, and it's specific to the client. The ALTA takes in all of the details of both, but takes out the confidential nature of the details that we were trying to avoid by a buyer and seller not getting each other's CD, right? So, is that a basic understanding? Because once we have that overview in our mind, we can then dig in and understand each form. So I just wanted to help with the way with the way realtors think.
And Dean, the ALTA is actually not required. The ALTA was born as a result of the closing disclosures not being combined. Great. So the American Land Title Association recognized there was a shortfall and came out with the ALTA, which is more similar to the HUD that we used to use. The difference
it kind of fixes the damage, right? Because things come out and they get approved in concept, but not necessarily in practice. So so we ultimately then shift and create a new process to make up for the deficiencies of this great new way of doing things.
Yeah, and even now, there's some attorneys that won't use an ALTA. They have, I've asked them for it and they said, well, the lender doesn't require it, so we don't use it. So in that case, to get paid, right, in order for you to get your brokerage confirmation proven that you've closed, you will probably need what, Dean? Both buyer and seller CD, or is one side sufficient for a broker?
It's going to be individual to each brokerage, but ultimately you should only be required to have your side of the transaction. Again, if there's not an ALTA, if confidentiality laws prohibit you from having the other side's paperwork, then why would you be required to have it for your brokerage if you can't have it because of disclosure laws? So, but speak with your management to confirm that. That's my opinion only.
Okay. I will say I can echo that sentiment. I work with lots of brokerages, and ultimately I customarily will hear they need something. Just a seller signed CD would be sufficient if there is no ALTA or the other attorney won't share the buyer CD. And some attorneys are fine with sharing the buyer CD, assuming the buyers have approved it at the closing with an authorization, which we all pretty much have. So there's lots of nuances between practice tips and what I do, what other attorneys do, that we'll try to keep dovetailing into this so that you're prepared for anything that's thrown at you.
And if I may, at the end of the day, if you're unable to get anything with numbers on it, get a copy of the deed. The fact that the seller signed the deed over to the buyer confirms that a closing took place. Is that a fair statement, Melissa?
Yeah, I think once it's recorded, that's absolutely a done deal. So that's a
Get a
good
copy of the
backup.
recorded deed, and you as the closing attorney would have the copy of the recorded deed, correct?
Sure. Yes, we would. In
So,
fact, we're usually responsible for the recording.
yeah,
Again,
so
getting it
when
right
all
there
else
in a
fails,
timely fashion of getting the copies of the recorded documents might be a
right,
little more protracted, but it
right.
certainly can be done.
But at the end of the day, that's at least your last resort, because
Right.
the recorded deed proves that the property conveyed, and if the property conveyed, both parties have signed.
Yes, yes, absolutely.
Right.
And one side note is a closing disclosure and a settlement statement, really, if there's a lender involved, need to be approved by the bank. One is more attorney drafted, where the closing disclosure comes from the lenders, just as a nuance there. But in no case are we supposed to be party to items that are outside of closing. All of the exchange of monies between the parties should be happening within the confines of this document. I cannot be party to it, and you as the agent certainly should not be party to it. Mortgage fraud is no joke. You don't want to be involved in, an exchange outside of the closing. Get it on the documents.
Can I go off on a tangent on that briefly? That is such a powerful statement that you just made. I'm amazed at how many folks, and I say this respectfully because we're all a result of those that we're working with, right? And there are a lot of folks in the industry that are like, okay, well, we'll do that outside of closing. We'll do that off the HUD. We'll do that. The seller will just bring a check to the buyer at closing. What I want everyone to understand is, if it's not on the closing statement, it's illegal. So that's the only way that I can best make sure. Now, there are ways to work around concessions between parties. Banks don't like the
Absolutely.
words credits, right? So there are ways to work around concessions. The seller could pay a contractor at closing, something like that. But
Even do a
no, I
price
just want to
range.
help everybody understand what's off the record. I've had many agents say to me, well, it's not off the record. The seller's just giving a check. It's like, well, that's off the record. If it cannot be on the closing statement, it is something. If we say the bank just doesn't want to know about it, that's because it's not allowed. And I'm just, I'm being a little facetious here, because I've heard many different explanations of how it's not illegal. Oh, the bank just doesn't want to know about it. Okay, well, don't give that addendum to the bank. What I want every practitioner to know is, regardless of the ways we find a solution, right? I mean, the bottom line is concessions happen, situations happen, repairs are needed. That's reality. We're not going to pretend to be in a different fictitious world. But at the end of the day, if you as a practitioner are drafting an addendum that includes details that are not on the record, then you are party to fraud. So if there is something going on between the parties, ask their attorneys to draft it and handle it if they're willing to, because just the fact that you drafted that agreement brings you party to it. So, and I'll leave it at that, but it's just critical that people know the difference, right?
And there are a lot of times where I'm asked to be involved and I explain, I cannot. It is mortgage fraud and you cannot. Let's figure out another workable solution. And I have hours of material that we could talk about at another time, ways that you can circumvent doing it outside of closing. So please don't get yourself in trouble.
Yes, I don't want to say it doesn't happen, but there's a right way and a wrong way, right? So I don't live in a fictitious world. I'm keen to all of the issues. It's just a matter of how we do it. But the bottom line is still whether it's legal or illegal and whether you're party to it. And my job as a broker is to protect your license. So that's what we're going to do.
So getting into how the agent would go about understanding the closing disclosure or the settlement statements, to kind of talk about them in totality. I think first you have to understand that as real estate attorneys, we're preparing these settlement statements based on the information and the data that we've received in large part from the agents. So communication is probably the single most important thing. And I actually beg of you to communicate with us as best you can, as often as you can, to make sure we know about these things that you know about, whether it's your commission bills, your reimbursements for smoke certifications, or purchasing a resale certificate. the oil or the fuel adjustments, the closing cost credits, the amendments to the sales price. I can't tell you how often, Dean, we're the day of the closing or the day before, and I'm getting, oh, well, that price is wrong, or what about this $5,000 credit? And what we just talked about, if the lender doesn't know about it and the attorneys don't know about it, that's a problem. And very often I'm involved in transactions where as a buyer's attorney or a seller's attorney, and I talk to the other side and they go, I didn't know about it. I didn't know about it. So if neither of the attorneys nor the lender know about it, it doesn't really exist. So you as the agent, that is your entire role, is to make sure you are communicating and over communicating this information to the parties that need to be preparing these final accountings, for sure. And that's why you want to see the documents before the closing so that you can review the accuracy and the completeness of it. Because if there was something that maybe wasn't properly communicated to the seller's attorney or to the buyer's attorney, maybe we still have an opportunity to include it on there. I think that we have to just talk a little bit about how we got here without boring everybody. The history of closing disclosures. So the Consumer Financial Protection Bureau was enacted, and it was born out of Frank Dodd and a lot of bureaucracy and painfulness, but it's intended to increase protection for buyers because a long time ago in the early 2000s, we had a lot of bait and switch transactions. And I know, Dean, I presided over them where buyers would sit at the table and say, well, that's not my interest rate. That's not what my payments are supposed to be. No, I don't think that's my loan amount, because they never saw the documents in advance.
Right.
It seems almost far-fetched to think that that happens because truth in lending, or the trade disclosure requirements, which is the Truth in Lending Integrated Disclosure, has been around since 2015 as promulgated by the CFPB. So we know that this has been longstanding practice now, 5 years, and we've just evolved. So to think about the history is really kind of interesting.
Right, and to think that it's 5 years ago, because this turned the market upside down, right? It changed everything,
Yep.
and rightfully so. It needed to, but navigating it and letting the dust fall, wasn't easy. But here we are on the other side of it, saying, okay, well, here's what it is, and here's how it works, and we like anything, we find our way through change at some point on the other side of it.
And the ultimate goal of the closing disclosure is so that buyers have a full picture of what their loan transaction looks like, and to make sure that they've had it 3 business days in advance of the closing so that they're able to make sure they understand it, ask any necessary questions, and deal with any open items so that when they come to the table, it's not a surprise. The workaround is that we're seeing that most lenders are actually sending out the closing disclosures during the underwriting process, with the exception of a select few. So for the most part, that initial CD, or ICD, as a lot of the lenders will refer to it, are going out shortly after, like, the appraisal, again, during the underwriting phase. So the numbers that the buyers see at the table still may have changed from what they saw previously. Are there still times for confusion? Absolutely, which is why this class, I think, is necessary. And sellers are usually left in a lurch where they're like, I haven't seen any numbers, because it doesn't apply to them. Consumer protection, it's for the buyer. Nobody cares about the seller. They say you can find it at the closing. And it's always been that way, Dean. You don't have to get it 3 days in advance. So I feel like this is probably one of the single most misunderstood topics that we talk about with the 3-day rule.
Right. Well, and I'm glad you mentioned that, because, again, reiterating, the seller is not subject to this. This doesn't mean they can't get information from the closing attorney prior to closing. You can still, as a listing agent, seek information for your seller, right? It's just that they're not bound to that 3-day rule. So we don't need to stress if we're on the listing side and the seller hasn't seen their numbers, but we still need to stress that the seller needs to see their numbers at some point. And on that buyer side, I appreciate you mentioning about sending the CD a little bit in advance, because we're working so hard to get that final commitment. And sometimes that commitment comes the day before the closing. And it isn't always where we have to wait an additional 3 days. When I say closing, the closing date on our agreement, right? And it isn't always that we have to wait the 3 days, because the buyer may have been disclosed. And to your point, there will be a change. That 9 times out of 10, if they're disclosed in advance of the final commitment, there will be some changes. But the laws require certain percentage changes. They limit it to certain amounts that can vary at the closing from the time of disclosure. If things change too drastically, they need to redisclose. So don't be afraid to ask the lenders you're working with what their policy is on that CD, especially as we're coming into the home stretch. You know, we've got these dates in our contracts and our clients are bound to it. But you know, and I don't want to go off topic here, but we need to realize that the lenders aren't bound to the dates we created. You know, in many cases, we as the professionals create the dates in our agreements. The lenders are going to do the best they can to stay within those timelines, but make sure you set realistic timelines in your agreements. Speak with the lender up front. We can only hold a lender accountable to a date they gave us, not a date that we created for them. So make communication, like you mentioned in the beginning, Melissa, communication is so critical at every stage of it. I still see these 30-day contracts coming across my desk, and you know, there are very few lenders that, and there are some, but there are very few that can accomplish that because of the workload right now. But more importantly, can the clients even accomplish that? You know, not every closing needs to be less than 30 days, you know, so communication is key.
And I think even communicating with the lender in preparation for the closing as you're nearing the commitment date, has the initial closing disclosure gone out? Have my clients been disclosed? And the clients have to acknowledge that initial closing disclosure in order to be compliant with the federal regulation. So what that means is that if it's just sitting in their email inbox, that's not enough. So if you have a client that doesn't tend to be a great communicator or involved with their email, you may need to be working with the lender to text them and remind them, hey, make sure you go in and acknowledge it, because your 3 days won't start ticking. And if we're only 4 days away from the closing, you really can't afford for them not to acknowledge it. So it is so important that you work as a team and that you are managing those timelines and those expectations accordingly.
Yep, absolutely.
One other side note, and I just want to mention it briefly, most agents and or sellers attorneys, I think, are drafting proposed net sheets for their sellers, which I think is useful, but making sure that the seller information is communicated upfront so that their payoffs are accurate and things of that nature really is so crucially important, so that you're not going to have a delay in getting the closing disclosure for the seller side, because we often are seeing we didn't get the payoff from the other attorney, or the sellers didn't fill out the information. So just make sure that you're over communicating. That's going to be the takeaway for sure. So we ready to get into the guts of the closing disclosure?
Let's do it. I do have a question that came in, and I just want to make sure that I read it. It may be further in our conversation, but I want to acknowledge it. The question is, does the lender need to approve both sides' CDs, both the seller CD and the buyer CD, or just the buyer's CD gets reviewed by the lender and then once approved can be combined on an ALTA with the seller side?
It's a really great question, and the answer is it depends.
Excellent. We love those answers.
Typical lawyer question answer, right? Most lenders do not need to approve the CD, but I can't say
the seller CD, you mean?
The seller CD, excuse me. Yeah, they all need to approve the buyer CD. My apologies. Right. But many lenders do not require approval of the seller CD. Some do. So you really just need to know the nuances of that particular lender as to whether or not they need to approve the seller CD, because that certainly can hold up production. If we don't have a mortgage payoff, the lender can't approve the seller CD, they can't release a closing package, we can't have a closing. You know, in theory, that's important. We need a seller's payoff in order to have a closing.
Now, so let me expand on that then. If the closing attorney does do an ALTA,
yes,
does the lender need to approve that ALTA?
It depends whether or not the ALTA is regulated by the bank. More often than not, the ALTA is really a buyer attorney preference opposed to the bank required it. However, once we've drafted it, it will go back to the bank with the closing package. So we can't do anything on the ALTA that's inconsistent with the respective closing disclosures.
Right.
So I guess in theory, they're approving it as a function of seeing both sides of the transaction, because they will see the seller CD. It's not that if they don't need to approve it, it's a secret. They will see it eventually.
Right. Okay, great.
Great question.
Thank you. Yes.
So as for the buyer's closing disclosure, and we're going to kind of go through some of the fundamentals, and then we're going to get into the guts of actually looking at one of these closing disclosure documents. The closing disclosure is very detail-oriented accounting of the loan transaction, again, with the expectation of it being an easy summary for the buyers to read. Page 1 is primarily focused on reciting the repayment terms. So it will indicate the interest rate that's associated with the loan amount. It will have an account number on there. It will reflect the escrow accounts that they're paying into monthly for taxes and insurance. So these are some of those kind of confidential protected items, Dean, that we keep dancing around. Non-public private information, an account number is considered confidential, which is why this is one of the documents, along with their interest rate, that maybe we don't want as closing attorneys to share with the sellers or the seller's counsel or the seller's agent. So the repayment terms as to what their monthly payments are going to be also will be included all on page 1, along with a summary of their closing costs. But the real details of their closing costs are on page 2. And this is where you're going to see an enumeration of lots of lender respective charges, like, and this is just to name a few. It really can run the gamut, but you may have appraisal fees, credit report fees, verification of employment, points, if they're paying points, any kind of VA funding fees or MIP requirements, if it's an FHA style loan. You'll also see customarily the prepaid interest, which is required on the mortgage. Understand that fundamentally mortgages are always paid 1 month behind. So when a client is going to be paying their first mortgage payment, the interest is for the month past. So that's where the prepaid interest is required at the time of closing. So for example, if we're having a closing today, December 8th, the interest is going to run from December 8th to January 1st, such that no mortgage payment will be due from our clients until February 1st. But when they pay that February loan, they're covering for the interest from January 1st through the end of January, because we got the interest caught up until that time at the closing. Does that make sense, Dean?
It does, but I do want to replay it because
Yes.
it's a lot of details if people haven't heard it. And I also want to lead in, you and I had spoken before we started the conversation, we've got every level of experience in our call today, right? So we want to be very mindful of that. We never want to get too elementary with some of the details for those who are very experienced with it, but we also want to make sure everybody's on the same playing field. So to reiterate what you were saying with that prepaid interest or interest, again, the mortgage is always paid in arrears. It covers the month that passed, not the month coming. It doesn't work like rent, right? So, but when the mortgage comes due, typically on the first of a month, it covers the month that passed. It doesn't cover the month coming. So that February 1st payment you just mentioned covers the month of January. But if you closed on December 8th, in your example, then your February payment will only cover January. You've got 23 days worth of days in December that weren't accounted for in that first mortgage payment. So
Right.
Those days of interest are collected up front at the closing in what the lenders call prepaid interest. So when you see an interest charge or prepaid interest, it's the number of days remaining in the month, because the first mortgage payment thereafter won't cover it.
And this tends to be the reason, Dean, that we see buyers preferring to close towards the end of the month, because it minimizes how much interest they have to cover on the loan at the time of the closing, thereby reducing their out of pocket. Now, take it out of one pocket and put it in the other. It doesn't really matter, because now you've just kicked the can forward. If you close on December 31st, you're still going to have a payment due on February 1st, but
Right.
you don't have as much prepaid interest required at that time.
Right. So it all comes down to what their funds availability is, right?
That's right.
Because in our first example, some people have the cash in the bank. They can pay those 23 days of their first mortgage payment, pay it now. It's like getting a free month in January, right? Because you don't pay in January, you pay on February 1st.
Right.
Or if you don't have the cash up front, it's better to close somewhat close to the end of the month. Allow a few days, because things get bottlenecked, right? If everybody did a closing on the 30th or 31st of the month, your office would be overwhelmed those days. We wouldn't even get to talk to you. So
Yes.
ultimately, also keep in mind, the lender in most cases have accounted for 15, sometimes 30 days of prepaid interest in the buyer's estimated closing costs up front. So we need to ask that question. The buyer may already have all of that accounted for in their closing costs and in any concessions if they're part of the transaction. So we may not need to worry about those 15 days worth of prepaid interest because it's already part of the equation.
Yeah, and so important that just popped into my head, Dean, is that the buyers, in large part, when they're looking at these closing disclosures, have already seen almost the exact same set of documents on the loan estimate, which are customarily shared with the client by the lender within 3 days of signing their loan application, which usually happens pretty close to the time they've signed the purchase and sales agreement. So in large part, this should be information that the buyers already are aware of and are prepared to handle. Like you said, they already know how much roughly they have to bring to the closing. Now, not every lender is created the same. Not every attorney or agent is created the same, right? But we know that this information should have been shared with the buyers in advance of the closing disclosure when they back it up to the loan estimate.
That's right. And I can almost guarantee that the information was shared with the buyer. Here's the issue. You're looking at it in reality, right? It was shared, but was the buyer listening? There is so much going on in a buyer's mind when they're making application. Oh my God, it'll be so nice when we move in because we can do this. And I hope I can afford to replace the carpeting. And, they get so caught up. It's like doing a showing. When you're doing a showing with a buyer and you're showing them, the kitchen, and you start talking about the age of the brand new heating system and all this stuff. And you go down, you look at the heating system and you say, and they look at you and say, well, how old's the heating system? Like, where were you when we were talking about that upstairs?
Right.
They were in a different place. So ultimately, there will be some things that will gloss over in a consumer's mind, not because they're not paying attention. It's because they have too much to pay attention to at that time. So you may be reminding them of the prepaid interest, but it may not be the first time they heard it.
Yeah, and this also is a brand new language for buyers, right? So in large part, we talk about this very quickly, and I know I do have a habit of going super brisk because I've been doing it for so long and it just rolls off the tongue like second nature. But it's almost imagining being in a international location where you sort of speak the language, but they talk so fast, because you're not quite fluent. So we do have to remind ourselves of that as real estate practitioners, that this is something that the clients may not, understand and be aware of.
Right.
Also establishing an escrow account. This is something that will include the taxes and insurances so that those are paid automatically by the client. Those have to be established at the time of closing per the closing disclosure. So they're not really expenses. They're more of prepaid items like the interest, but it is something that would be included in their final figures. Title insurance premium, attorney's fees, recording fees to make the transaction official at the town level. And of course, prepaying that 1 year of homeowner's insurance, all standard items that we'll see on the sample page 2 of the closing disclosure in just a minute. Page 3, and it's interesting, Dean, you were mentioning earlier that we really can't make a lot of changes between the lender and the buyer because the interest rate and the payments really shouldn't change, folks. From the time of the loan estimate to the time of the closing disclosure to the time of the closing, that stays the same. But where we see a lot of shifting around tends to be between the buyers and the sellers, because that's where the information has to backfill because we may not have it at an early place. And this is really where page 3 is. Page 3 of the closing disclosure factors in everything that the buyer is responsible to cover in addition to those costs that we just addressed. So you'll see it sort of broken out in a debit and credit format, starting with the sales price, right? Very basic. What are they paying for the property? What are those closing costs that they have to cover that were on page 2? And what kinds of reimbursements do they owe the seller for the fuel, for the prepaid taxes? So these are the kinds of places where a lot of times that information is shifting around.
And to clarify, you'll look at each component of the CD. So if anybody's saying, well, can you show me page 3? We'll show you that, right? So I don't want people saying, why aren't we turning to page 3? Because we're trying to do a little bit of an overview. That does allow me an opportunity to throw in one of the questions that came in as well, because we talked about concessions between the parties, and if you're party to drafting an agreement for something that's outside of closing, then you're party to potential mortgage fraud, right? There are many ways that repairs are the biggest thing we see that comes up after the fact, right? The seller wants to provide some relief for repairs, but would rather give the money in order to go towards the repairs so that the buyer does the repairs after the closing. because the seller doesn't want to deal with it or is too busy to deal with it. And we'd rather have the buyer's own contractors do it the way the buyers want it, because unfortunately buyers are seldom happy with the way a seller performs repairs. So providing a monetary concession to a buyer is the easiest way to solve repairs in most cases. It's just not something we can do off the closing statement. There has been a method where folks work out a repair, say and it can't be too large of a repair. We're not talking replacing a roof or installing a new septic or something, where a seller can pay a contractor at closing to go towards a repair that the buyer is going to perform, say the week after the closing, so that the seller's not part of the details. So, is that something that, that a licensee can be part of coordinating? So, if it's, let's say it's a $500 electrical invoice or something, you can pay electrical invoices or contractor invoices on the seller side of the transaction, correct?
Yes. So right now we've been primarily focused on the buyer side of the CD, and that is one of the shortcomings, is that you don't see the seller side. So you wouldn't see those items yet. But as long as there is an invoice for the work to be performed and it's being paid to that third party, this has routinely become a way in which parties are able to manage repairs that just fundamentally they don't have time to get completed in advance of the closing. Ideally, all the work should be done in advance of the closing, or instead of making a concession like this, maybe you make a price reduction, or you do some other type of concession if there's not already a closing cost credit. That would be my first two choice ways of handling it. But when you get right down to it, hey, the contractor couldn't show up, there was a situation, or whatever the case may be, yes, it can be done so long as we have an invoice.
Right, exactly. And yes, the ideal world is, it's all part of the sales price. But let's be honest, reducing the price affects the buyer's mortgage payment in a very small manner. It doesn't give them the money to do the repair. So,
and that's always the rub, is that's great, I got $500, where is it? Because I need to pay this contractor now. Right. So I do get it. And the nice part here is that at least you have it in writing. So if the seller had just written a check to the contractor, that's not mortgage fraud. There's nothing going on within the confines because it doesn't impact the buyer. It's to a third party, which is really the crucial piece.
Well, and that's the key. It's to a third party. So in drafting, in relation to the question as written, in drafting an agreement that the seller is going to pay, in this example, an electrician $500 at closing to be applied towards the repair that's stated, that's not going outside of the confines of the agreement, because the seller is just simply agreeing to pay an invoice at closing.
Right.
Yep. Great. Thanks for the question.
Problem. So the lower section of page 3 of the closing disclosure for the buyer side are basically the credits, which would reduce the items that the buyers owe. And this is the first time you're going to see reference to the deposit. And if you're on the seller side, it may be the only time you see reference to the deposit if there's no ALTA, because deposits are not usually on the seller's side, just like the seller's expenses to the contractors aren't on the buyer's side. So there are some limitations.
And Melissa, I'm sorry, I'm going to interject on that. It's important that we say that again.
Yes. So I was just going to say, there are some limitations, because there are places where you don't see the deposit on the seller side. There's places where you don't see expenses on the buyer side that belong to the seller side. So that's why the ALTA, in my mind, is so crucial, because it is that shared disclosure.
Now, and the reason I'm going to say that, the reason I say it, because again, I bring it into practice, right? If you're on the listing side and you're holding escrow, your company's holding escrow, your company needs to know, if you're giving them a seller CD and it doesn't show the escrow, you need to be confirming your invoice. And we're going to get to your brokerage fee invoices, because that's a hot topic as it relates to us in the field. But you need to confirm escrow deposit amount in relation to your brokerage fee. And if it's not on that CD that you're turning in, you need to make sure that you're watching to make sure that it was accounted for. And that's why I asked you to reiterate that, because it's critical information and we're not getting it to confirm it. So it's just important that conversations happen. It comes down to good old-fashioned communication, right?
Yep, absolutely.
Great.
Said it once, we'll keep saying it. You'll also see the reference in the credits to any closing costs that may be applicable, any kinds of municipal credits between the parties, which are tax credits. And then the difference is really truly the bottom line. What does the buyer owe at the closing? And I cannot stress this enough. It needs to be certified, folks. We need to have either a bank check or a wire. It is required. And I am always amazed, even though we put it out in email, we tell people they need to bring certified funds. I had a closing yesterday and they showed up for 23,000. They thought they could write a personal check. You cannot do that. So please help us as the agent to make sure you're communicating with your buyer client that they know they need to bring these monies to the table.
Great.
Page 4, I just wanted to touch on, I think there's a lot of.
And again, if I may, Melissa, I'm sorry.
Sure.
We're going to go through each page, correct?
Yes.
Okay, I just want to
Yes.
make sure. We've had a few folks asking to see the pages, and I
We're
promise
going to see
everyone,
them.
if
We thought this would be easier, Dean, maybe we were
right,
wrong.
no, we did, we agreed, but some might have logged in a little late or what have you, may not caught that. So we're truly just going over the basic details in all of these forms, and then we're going to show you exactly where all of it is.
Yes. So page 4 is really a form of disclosures, a lot of which are terms that will be confined within the body of the promissory note. I don't usually even focus a whole lot on the page 4 with reviewing with clients, but if you have a client that's very detail oriented, understanding what some of these terms mean as to your assumability feature, if they can have a late payment, if there's any negative amortization, might be useful. I don't want to waste our time here because we're already running a little bit long, but we'll touch base in a minute.
Great.
And then page 5 is really going to be kind of your signature page. There's going to be a host of contact information, and this is where you're going to see the amount financed, which is kind of an ugly number. So without further ado, let's get into the closing disclosure.
Awesome.
This is page 1 of the closing disclosure, and what I'm going to do is try to give it to you in big form, and then we'll get into the smaller pieces. So at the top here, you're going to see, the closing dates. The amount of the sales price is referenced here, the lender and the party details. And then
Can
this
you
is where you
increase
see.
the page just a bit?
Yes, I will.
Thanks.
The loan ID number. This is that account number that everybody's so afraid that anyone's going to see. It'd be easy to redact, but again, there's other details that the buyer may not want to share. So on this page 1 of the closing disclosure with the repayment terms that I had promised we were going to address, this is where you're going to see right in the loan terms, the loan amount right here, the interest rate that you can see, and the principal and interest payment that you're going to be responsible for as the buyer. I'm trying to highlight, but it doesn't want to work for me. So that's okay. You all with me?
Yes.
Okay. And then you're also going to see the features of the loan. Can the loan have a prepayment penalty? No penalty. Does the loan have a balloon payment, which means that at the end of the term, you owe a balance? No. If either of these questions were yes, Dean, there would be disclosures explaining what that means. And that would be a really important place if the buyer had questions about, to probably defer them to their loan officer or their attorney, because it's going to go beyond the scope of this class.
Right.
But for the most part, most people are in a straight 30-year fixed loan program. You're also going to see about halfway down the page here in the projected payment section. This is where we see, again, the principal and interest that was from above. I don't know why I can't highlight. You're also going to see, oh, maybe I have to select my color. Nope. You're also going to see if there's any applicable mortgage insurance as reflected here. None on this particular transaction. And then what their estimated escrows are. Understand this is for taxes and insurance. So this is where it's showing you your full payment. Now, something that can be a bit confusing is this estimated taxes and insurance assessment section, showing that the buyer owes $583.19 a month. That's a place where buyers often get tripped up because they think this is in addition to the $1,029.86 payments that they're making. But understand, Dean, what this is intended for is to show the taxes and homeowners insurance, which are included in the escrow. So they're referenced here above. But I happen to have it on good information that this particular transaction is also a condo. So the lender has included the condo fee in here, even though you don't see it anywhere in this document, because it's not part of the mortgage payment.
Interesting. And I was actually going to ask, why is it different than the 310 above?
That's why.
So, because
it's
in general, they should match, right?
Yep. It factors in that additional monthly liability so that the buyer knows if you take the 719 plus the 583, that's really more what their full financial outlay will look like monthly. But if you were to take that and add it to the 310, you're going to have a really panicked buyer because they're thinking, where did all this extra money come from?
Right.
So this is a really important area to understand as an agent.
Great.
And then this lower section just shows the closing costs that are owed at the time of close, which you're going to see in a second on page 2. And the bottom line, truly the bottom line, is what is going to be owed at the time of closing. $40,000, $73.75 in certified funds. Okay. Am I going too fast, Dean?
No, not at all. And if you notice in each section, it has the little reference. See page 2, see
Yes.
calculating cash to close on page 3. So,
Yes.
when in doubt, just follow the prompts.
Now, page 2, if I zoom out, you go, ay, ay, ay. There's a lot on here, folks, right? And I get it. It's a lot. At the top is really where you're going to see kind of those basic loan terms and attorney's fees. And I don't want to necessarily get into the details because, Dean, as we've talked about before, it doesn't matter, right? For purposes of this class, you just need to know where you should be seeing.
I'm glad you said that. Yes, because ultimately the lender can explain to you what the lender's costs are and why they apply. Every loan product is so different. Rely on the loan officer. Gang, the best way to learn what the fees are is to ask the loan officer to explain them. Ask to be present when they do a pre-approval. In today's world, I know it's different, but be present whenever possible. The best way to learn lending details is to just sit in and listen. But what all of these costs are is going to be particular to the example that you have here, Melissa, and it won't matter. So I urge anyone, if you want to know what is an abstract, what is title insurance, what is all of this, have the lender explain it so that you know exactly how it applies.
Yeah, absolutely. And one point I wanted to make, and it's not referenced on here because this particular loan was actually subject to an appraisal waiver, but a lot of times you'll see an appraisal fee reference somewhere in here. And you may even see it referenced in this column here, Dean, that I wanted to draw to your attention, which is the paid before closing section. You see that?
Yeah.
So this is where if something was already prepaid, it would be referenced. And most notably, we will see that in homeowners insurance and with appraisals. And again, this is a space where buyers get really, I don't understand. Why is it included? I already paid for it. We know it's not added into your bottom line here. It's just a way for us to be aware of it. You're going to see the recording fees referenced in this area. Again, government fees, that's where you're typically going to see it. The prepaid section that we had talked about for the interest and the homeowner's insurance, again, right here, you can see the prepaid section. Mm-hmm. Oh boy, don't have a steady hand.
Your highlight isn't working, huh?
No, it's not working. It's really crazy.
Yeah. And one thing I'll mention on the prepaid section is, it's important for us to note, when we do get those panicked calls, right? I got my CD, I don't understand this. If a borrower has paid 1 year upfront to their insurance company, it may be listed here as an expense because they didn't know that it was paid or the payment hadn't been received. So they're only going to pay it once. They're not going to pay it again. In most cases, it's just paid at the closing. You get a binder from the insurance company, which binds the insurance company to 1 year's worth of coverage, and it's paid at closing. But sometimes they pay it right up front when they get that binder, depending on the insurance company's policies. So know that they're not going to pay it again.
Right. And sometimes, Dean, I've seen it where there's a strategic use where in order to fully use a closing cost credit, we may pay something that the buyer already paid because the lender can say, well, we didn't charge the credit card, or the insurance company can say, no, we didn't charge the credit card yet. You think it's been paid because you gave them a credit card, but it doesn't mean they've actually posted it as paid. So there may be other reasons where that happens. So try not to panic.
Right. And if I may, because we're lumping all of these costs together, when you have a closing cost concession, again, the lenders hate the word credits. When you have a concession, the key is the lender has what they call allowable costs that can fall under that concession amount. It's critical that you get the concession amount upfront at the time of sales agreement or the offer from that lender, because if you negotiate a $5,000 closing cost concession and the closing allowable costs only come to $4,000, the buyer loses that $1,000 because the seller keeps it. So if you've inflated a price in negotiation, 5,000 to include a closing cost concession, the seller cannot strike a check for $1,000 to the buyer at closing. So you've just given the seller a bonus. Again, it's important that you speak with your lender to make sure that any amount you roll into a purchase price, that the buyer gets the full advantage of.
Right. Good point.
So those are the costs here that all come in this section, just kind of broken down into line items.
Exactly. And Dean, if there are any specific questions, I'd be happy to, answer them. But again, I just didn't want to focus too much on the nitty-gritty details, because I don't want to say it doesn't matter, but you just need to understand the fundamentals of what we're looking at.
That's great. No, and I always hate going off topic, but I want to make sure, because we appreciate questions, quick questions, just slightly off topic, getting quickly back on topic. One of the question is, when is a closing technically considered final in Rhode Island? We always hear these differing answers. We hear that it's at the closing table, all parties have signed, if they were all at the table, once all parties have signed, and some people say it's when the deed is recorded.
Yeah, so
it's a varying debate out there.
it's a loaded question. I mean, a year ago, my answer would have been very different than it is today, to be completely honest with you. I've always subscribed to the theory that it has to be recorded. That's when it's final. We're a race state in Rhode Island, and that's what has to happen. But under COVID, we have had to relax that standard. And thankfully, the title companies have allowed us to use gap insurance. And again, I don't want to go too far down off topic, but basically, we do not have to be officially of record or recorded, so long as all the parties have signed, so long as it's fully funded, and so long as we have been able to update the title search within 30 days of the closing date, we are able to now disperse the transaction as if it's recorded. So proceeds are released, buyers are given access, payoffs are made, insurances are canceled, and it's a leap of faith. And that's why we have title insurance. In fact, we took a policy decision, as a lot of attorneys have, that we won't close without an owner's title insurance policy, because if there wasn't for the gap policy of title insurance, we really wouldn't be able to do what we do, especially in light of the number of town closures that we've had.
Great. Excellent. Thank you. Again, I'm going to watch for timeliness of questions. So
thank you.
Continue.
So section G is indicating here what you have for the escrows. This is where you're establishing in 3 months of homeowners insurance and some taxes. Oftentimes you'll see a credit. This is a function, Dean, because there is an overpayment. Federal regulation won't allow for the bank to hold more than a certain amount of money in the escrow account. So the bank will say, in theory, they're going to collect all these items, and then they realize they really can't. So that's why you end up with a credit back.
Yeah, it's interesting that they do the formula and take their standard escrow amounts, and then when it goes into the overall picture, they realize their standard formula actually is too much. So they have to give it back, and they give it back on the same day that they took it. So, I've always been intrigued by the aggregate amount.
It makes no sense, honestly.
Right, it really does. That's the one thing we'll never make sense of for you.
Why not just take 1 month of homeowners? Why take 3 to give back 2? I know, get it. But somebody smarter than me, I guess, knows this stuff.
That's right.
So the owner's title insurance, this is the last piece. And again, these items really can be reflected in a lot of different places. You may see some of this on page 3, where we're going now, depending on who the closing attorney is that's drafting it. For the most part, these documents are intended to be universal, and it should be. But I have seen CDs that look a little bit different. You'll see at the bottom, section J, that's always going to be your sum total of page 2. And that's where, and if there's a lender credit, Dean, you might see it referenced right here.
Right.
So if the lender is giving a credit, you'd see a negative, and then the net difference is what's going to be carried to the 3rd page. Because remember, the 3rd page is sort of our debits and credits section.
If I may, before we go to page 3,
sure.
Just talking back at the owner's title versus lender's title.
Yes.
Only just a quick synopsis for folks. There are two forms of title insurance: lender's insurance and owner's insurance, title insurance. So the lender requires that you have lender's title insurance to protect the lender if there is a title defect that's discovered at some point with this property, something that didn't come up in a title search either now or in transactions past in the history of the home. The owner's title insurance protects your borrower's equity. As the equity builds in the home, then their ownership is protected. So if you have a $300,000 home and you're borrowing $250,000, lender's title covers $250,000, but the $50,000 of the borrower's equity is not covered if something comes up. Sure, the lender gets their money if something happens where this property has to, switch hands again. But
Right.
and over time, over many years, everybody hopes to pay off their mortgage sometimes, right? It's at some point before we leave this earth, and you're building equity. It's a one-time payment to protect the full equity as it grows. So I just want to make sure people know the difference between owner's title and lender's title insurance.
Absolutely. And I have a lot of literature that I can share and videos on YouTube and such that really gets into the guts of the distinctions, which is also helpful for your buyers.
Great.
If you as the agent don't want to be giving this information, you can direct them to our website or other sources for that.
Perfect. Thank you.
Yeah. So page 3, my focus is really the lower sections in section K and L, but this upper section tends to be an area that people want to look at. And I go, oh, don't worry about that. The final is intended to show you what the final closing costs are, the final down payment, but the loan estimate is showing you the comparison that the lender had given the borrowers in advance. So you can really see how close the lender came at the time of the initial disclosure at the loan estimate versus the final. That's the intent of that table. Not really terribly useful for me, but it's nice for reconciliation if the buyers want to see.
Right, and it literally shows right on the last column there, did this amount change? Yes.
Exactly.
And, so,
Yep.
It's just a quick check to see were they properly disclosed up front at the time of application.
Yep. So the summary that we're going to focus on here is in section K on the buyer side. Now this seller side, interestingly enough, sometimes is completed to some degree, sometimes has less detail. The lenders generally produce the closing disclosure, and in that case, there'll be almost nothing on it. But the way I had to create this document for purposes of this class, it came from my system. And there's no way for me to hide the information once it's there. So that's why you're going to see a little more detail on the seller side of this closing disclosure than you would in a true bank prepared closing disclosure. Okay, just so everybody knows.
Great.
This side is, of course, our focus, and this is where you're going to see the sales price, which is our starting point. This number, oh, by the way, this is the only document where you'll see math adds up, which I forgot to mention in page 2. But this is what the buyer owes, which is comprised of your sales price, the closing costs that we saw on page 2. You have the working capital because this is a condo. So this is basically a requirement for the association to buy in, which should have been outlined in the sales agreement and prescribed in the resale certificate. So that's an item that the buyer owes that we're collecting. We're also prepaying a condo fee in this particular one because of the timing of which the condo fees come due. Remember, they're not going to have a mortgage payment for this particular client due until February. So their condo fees are quarterly, and the first quarter is due in January. So we, as the buyer's attorney, are required to collect it up front because the buyer's lender said we have to. The buyer's lender wants to assume that this buyer has no debts, no obligations, and for the next 60 days, they don't have to worry about paying anything until their mortgage comes due in February. So that's why we're collecting it, so that we can prove to the bank, don't worry, there's still plenty of money in their checking account when the dust settles. We also made an adjustment here for the condo fee for the month of December. Again, this closing took place last Friday. So from the 4th of December through the 31st, this was the respective adjustment for the condo fee between the parties. And again, this is all prescribed in the body of the sales agreements that they are going to make these types of municipal and personal types adjustments. We're just doing it appropriately on the settlement statement. So these are the places that as a listing agent, if you are working with someone who's already paid their taxes, they should be getting a credit back. If they've already paid those condo fees, this is where they'd be getting a reimbursement. If there was a fuel adjustment for propane or oil or a contract that they've already paid for a maintenance program, this is where you would see those types of reimbursements. Okay.
If I may, I'll also add, if you notice line K is the total amount and the amounts are underneath it. So
Yes.
it's reverse psychology here. Normally we have a list of expenses and the total is underneath it. the total is at the top. So that's a reverse. So
New
you know,
math.
when you're scanning something, those are, you want to make sure you're looking at the columns the way they read, not the way you think they would.
Yeah, I always say this is the only place where you'll see math adding up.
Yes, exactly, right.
Yep.
It's
And
it's
that's how it
comical.
was, Dean, even on page 2. If you look back at page 2 and you want to look at how much are you paying for prepaids or for escrows,
Right.
again, the math is adding up.
They're all right. So
It
it's kind
makes
of
no
like it
sense.
gives us the amount and then the explanation as opposed to the
Exactly.
breakdown.
Yeah,
So,
which again can cause confusion for clients. So that's definitely worthwhile to know. So the credit section that you're going to see for our buyers that we referenced before, again, the sum total of your credits and then the detail itemization. The deposit that the buyer paid is referenced right here. The loan amount that the buyer is receiving is referenced as a credit because it reduces what they owe me, along with the closing cost credit that the parties agreed to and the tax credit. Now, municipal credits are one that really can create a lot of confusion, Dean, because parties still have a difficulty understanding that most communities in the town, in the state of Rhode Island, are in arrears. So what that means is that the taxes are paid 6 months behind. This particular client owes taxes for the fourth quarter because they owned the property for the fourth quarter of 2020 and they've not paid the taxes. Why? Because the taxes are not due until April of 21.
right.
Doesn't make a lot of sense. It's just the way the math works. So that's why you see an adjustment here from the beginning of the fourth quarter through the closing date in credit favor to the buyer, because the buyer, understand, is going to pay that fourth quarter bill out of their escrow account when it comes due next April, because at that time they will be the owners of the property. So this is really an important reconciliation item that you want to address with your clients when you're doing a net sheet as a listing agent, because I guarantee you they think that their taxes are current. And
Yes.
they are in their mortgage payments, but they're not current with the town because the town is behind.
Right.
Which,
And that's a big deal because it is hard to follow, because the general question that we ask our sellers, are you paid up to date with your taxes? Oh, yes, of course I am.
right,
And they're not. And that's only because of the billing cycle, you know.
right.
And you know, just final point on that is what we need to realize is that the bill is for the calendar year, but the bill does not come out until the middle of the year. So any quarterly payments from that point forward are always 6 months in arrears. It's just the billing cycle, right? So, you know, so ultimately it's a matter of making sure the seller pays from their last payment date to the closing date, because they still owe for that period of time.
Now, the inverse of that means, Dean, they should presumably have an escrow account balance with their lender, which will
Right.
be refunded to them after the closing.
After the closing,
Always-
right? It won't, it's a
always
big
wanna
deal for
remind-
sellers. If sellers are really tight on their numbers, on their margins, and going into their next property, you know, a surprise of 4 to 5 months worth of taxes, depending on the tax rate, you know, could really set them off in their next purchase. They'll get their money back from their lender, but when, right? So,
About a month on average.
Yep.
So that is a really important piece to factor into the conversation.
great.
So again, you're just going to see, and if I zoom out a little bit, you'll be able to see sections K and L above are just netted at the bottom, right? These are just the numbers that you saw ahead up
Yep.
top to equal that net number that's due to from our buyer at the time of closing.
Great.
Page 4, as promised, you know, again, I don't want to waste too much time here, but this is where you would see the indications of the assumability features, if there's a demand, if there's negative amortization. A lot of this is going to be housed within the confines of the promissory note, but if your client has a question on these, you probably are better off deferring them to the attorney, because these may be things that you're not super comfortable in explaining.
Right.
Although we can go through the details of it, I just don't know that it's useful for the time we have remaining.
Yeah, and I think you've handled it well with the overview, because ultimately when we stay relevant in conversation, right, no licensee should take on the obligation of explaining these pages. So when we look at, I'm going to give everybody the permission to step out of this explanation page, because you need to refer them to their loan officer for any questions. We can help them with how to find things, to sort through it, but the last thing we want to do is rationalize the loan product that they agreed to with their lender, because it's not our place to do so. So I want to give everybody permission to defer.
And page 5 will follow on the right with other disclosures, kind of following suit with a bit of information that you're probably not going to get your teeth wet on, or teeth into. And then the loan calculations, I do think this is one that is of interest because a lot of people want to know, well, what do I pay when the dust settles? And it's an ugly number compared to what your loan amount was, but that's it. I just glaze right by it because I don't want to depress my poor buyers. I mean, we're on
Right.
page 5 of the signing. They've got a lot of signing ahead of them.
And
so
many buyers will never be there 30 years anyway, so they'll never even get to that point.
quite likely not. This contact information, again, it's blank to protect the innocent here, but usually you'll see a whole host of information. So as the co-broke, you'd be referenced here. As the listing agent, you'd be referenced here. And there's lots of good contact information. Emails you can see are referenced, phone numbers. This is all your information, and we get it from the sales agreement, you guys. So make sure that those sales agreements are accurate and have that information correct, because otherwise it won't be correct. So that's the highlights on the buyer side of the closing disclosure, Dean. I want to jump back to the seller's closing disclosure, which
Yes, no, and that's great, because seeing that breakdown allows us to easily see the items that are pertinent to the seller, right? So, and that's why
Right.
when you and I talked about this, we said, let's start with the buyer CD because there's so many more details on there. So yes, let's shift to the seller CD.
So the seller CD is going to be a final accounting for the sellers only, as you'd probably expect, and it's just the inverse. The credits are going to be all of the incoming items for the sellers. So you're going to have a sales price, and then you're going to add to it whatever the seller is due back for reimbursements, as we've talked about, for fuel, for overpayments, for any other kind of credit balances, minus what do they owe, right? This is going to be their closing costs. And this is really where we start to talk about commissions in a more meaningful way. Yep. Mortgage payoffs, credits, reimbursements, mortgage, that kind of thing. And I do want to just, before we get into it, Dean, I think this makes sense to talk about the closing cost credits and the commissions a little bit, and then we can see it in an itemized fashion. Does that work?
Yes.
Okay.
I also want to be mindful of everyone's time as well. So let's make sure we hit on the details timely.
Yes. So a closing cost credit, how it's applied, I think we've spent a good amount of time already adjusting, but in large part, closing cost credits are referenced as a lump sum, which is what you saw on the buyer's disclosure previously of $5,500. That's not always the case. There are occasions where the lender will prescribe that the buyer's expenses will actually be itemized on the seller's CD, which can create a ton of confusion. So you don't have an example of it here today, but it is a place where that would be a time to pick up the phone, get on the horn with the closing attorney, the seller's attorney, the lender, just so that you can really understand. Now, in theory, you know the details of a verification of employment, a prepaid homeowner's insurance policy. Those are buyer's expenses. So hopefully you can help carve out what are buyer's expenses versus seller's expenses. But this is why you really need to have a strong command of what are buyer's and seller's expenses. And repairs and how they impact the commissions. Dean, I just wanted to digress a minute about whether or not, if a closing cost credit is masquerading as a repair credit, which we know so often it does, right? There was no closing cost credit.
I don't know what you mean, Melissa, but it's a great example for you to make up.
Yes. We know that the property needs about $5,000 worth of repairs. So we're just going to add an amendment for a closing cost credit to have $5,000. And now that's fine. The buyer is paying $5,000 less. We didn't do a price reduction, which we could have done, and it would have facilitated the exact same outcome, right? The buyer is bringing $5,000 less to the table. If we did a $5,000 price reduction, the commission would have been reduced. But is the commission going to be reduced if you offer a $5,000 closing cost credit, which is really a repair credit? And then I phrased the question, well, what if your seller was just spending $5,000 in repairs? Would you reduce your commission now? So you can start to see that I'm teasing this out because the answer is 3 different answers, 3 different sets of scenarios in the fact pattern I'm outlining, which really just underscores the need to communicate. Because
I'm actually going to solve that dilemma for you, Melissa.
Thank you.
MLS rules and regulations require that a licensee list in the compensation comments any amounts that would reduce in formulating the net sales price for any concessions that are paid. So it can be referred to right in MLS, because if the net sale price is calculated just on seller closing costs or seller paid closing costs or concession, that's one thing. If it includes any alternate repairs, that's another, but it needs to be identified there, and that is the fallback. It's a required to be identified, or it's not included in that calculation. So as a lender, you can fall back on that. The only thing I'll add is, if, to your example, if there's no close, and this will answer one of the questions that we have up here as well. If there is no closing cost concession, and you're utilizing a means by which a seller can give a concession to a buyer and masquerade it as a closing cost concession, that makes sense, because lenders allow for closing cost concessions, and it's that much less that the buyer has to come up with at closing. Thus, they can now use the other monies towards that repair, right? Makes perfect sense. But if you have an amendment that says that there's a closing cost concession from the seller to the buyer, that becomes a closing cost concession, even if you disguised it and, well, that's really a repair concession. Well, tough luck, you called it a closing cost concession. That's really how the computation happens. So all you can go by is what's in writing, right, Melissa? All we can argue is what's in writing.
And I think it's a conversation to have with the sellers when you're taking on the listing, to identify if they need to take money out of their pocket for credits for these types of things.
And we're talking such a small amount of money, right?
It's like
But every penny counts. So that's my take on that.
That was my sidebar on it.
So, and to the point of the question that we have at hand, is there's a question that there is an agreement between buyer and seller, where the seller is giving a sum of money to the buyer at closing. How is that handled? Well, we hit on that in the beginning. Please know that the seller cannot just give money to the buyer outside of closing without bordering on mortgage fraud. So if it's just a concession between the parties, just because, and a check is going to be drafted outside of closing, then you should not be party to it. Bring your manager or broker in on that right away, because the seller is pulled into a situation where they could be creating a situation they don't want to be in legally. So
yeah, and I think the one exception there is if they're truly buying personal belongings, and there's actually MLS forms that allow for that. You can even have a bill of sale drawn up for those instances, but we know that's not what we're talking about.
Yep, agreed. Yep, and that I just wanted to answer the question that we have in the chat.
Good.
So thanks. Okay. So seller just
dented over to commissions. I want to stick with it for a minute relative to deposits and commission bills and the drafting and the way these are reflected, because Dean, we've seen lots and lots of problems relative to commissions. First, let me just start by saying commission statements are so crucially important. We need your commission statements. We can't guess what your commission bills are going to be. Some brokerages will allow for administration fees. Some brokerages will do an even split of the commissions between the parties. Some brokerages won't allow us to split the commissions between the agencies. So we really will do whatever the listing agent's commission bill reflects. And the CD or the ALTA or the HUD or whatever settlement statement you're looking at should accurately reflect your bill. The deposit piece is really where we have some questions, because the buyer CD will reflect the deposit. The seller CD will not. What that means is that your commission should always be grossed up. So if you're charging a $20,000 commission and you're holding a $5,000 deposit, the closing disclosure should reflect $20,000 commission. The deposit is just the money that you have in-house. I, as the closing attorney, am going to essentially net fund the amount of the deposit that I pay to you, so that you're only getting $15,000. When you take the $5,000 in your escrow plus the $15,000 I've given you, you've got the full $20,000 to then disperse to the co-broker, split it up however you choose. But just because the deposit's not on there doesn't mean it's wrong, as long as it's grossed up and it matches your bill. That's the easiest way commissions are.
Yes, no, and I'm glad you explained that, because ultimately, gang, you all need to be comfortable reviewing this line item in any trade, business, career. You get an invoice for services due, and you always look at that invoice and make sure the invoice is correct when you get that payment. Okay, don't make a spectacle of yourself looking at this. I call it brokerage fee for a reason. This is a fee for brokerage services rendered. This is not a commission. Salespeople get commissions. We are real estate practitioners. We're professionals. it's okay for you to confirm the amount due to ensure that it's the correct amount, and ensure that the attorney, respectfully, Melissa, has cut a check for the right amount at the closing. Please confirm that. And in the spirit of seller side of things, if you are on the listing side of the transaction, you should be submitting an invoice for the full commission. By law, you have a listing agreement with that seller that holds them accountable to the full amount, whatever that percentage is, and you agree to pay a co-broke. But at the closing, you need to be collecting that full amount on your invoice, even if there's an adjustment where the co-broke is paid at closing. As a listing agent, your invoice needs to show the full amount, not just your half. That is something we're seeing recently where, you know, as a co-broke buyer side, you're giving for your half. On the listing side, you're responsible for the full amount. We've had folks have to chase sellers who were not billed at closing because the closing attorney has no way of knowing the accuracy of that invoice. All they can do is pay the invoice you give them.
Yeah. And we don't do the math. We frankly don't have a lot of the time.
You
There
shouldn't
are
have to.
occasions we might eyeball it and say, geez, that number looks weird, but the chances are it will slip through the cracks. So as a listing agent, you're the one with the privity of contract to the sellers. You're the one who's responsible for collecting the entire commission, regardless of how the attorney is instructed to adjust it. Make sure you're collecting the entire commission. I cannot help but repeat it because it's so important.
No, and I'm glad you did. Yeah, absolutely. Make the ask and review it. You know.
Yep.
So again, I want to be mindful of time. We allowed about an hour and a half for this, but we want to make sure that we're hitting on all of the details. For those who are able to remain on the call, we appreciate that. You know, we've had some great topics, and I think our overview really hit well on many subjects that prevented the need for some of the questions. In the spirit of being mindful of folks who did make questions, real quickly, and then we're going to jump into the seller CD. Owner's title insurance. If you purchased it when you first bought the property, if you refinance the property, do you need to buy it again?
No, owner's policy will last for as long as you own it.
Perfect. I just wanted to make sure we had that answer.
Sure.
Thank you. Great.
I do want to stick with excess deposits for a minute, Dean, because
Please.
this can be of issue, again, especially with agents not attending the closings. If your buyer has overpaid the brokerage for the commission, then the listing agent is going to be responsible for getting a check either back to the seller or to the closing attorney. And really, it's not one size fits all here, folks. And even the way the deposits are reflected, I mentioned it in my example, there are occasions where attorneys will reflect a deposit on a CD. And then as a result, the commission is not grossed up. It's going to show the balance of the commission. It doesn't happen often, but it can happen. So you have to really be, again, fundamentally understanding the way these are going to look and communicating it so that you know whether or not these are properly reflected. If there is an excess deposit, the money should be paid to the attorney, in which case there's going to be, dispersed as proceeds. If the excess deposit is going directly to the seller, then there'll be a line item for excess deposit to seller, because now it's getting everything kind of accounted for, if you will. And that really does get to a high level of confusion, not only for agents, for brokerages, for attorneys. Excess deposits are a thing that need to be kind of addressed in advance.
Yeah, and
So
again, you can speak with your broker or manager. Ultimately, if you know that your deposit is more than what is due for the commission, then somebody's got to get the difference of that back, right? So,
right.
So like you said, Melissa, draft it to the closing attorney. They can disperse it where it needs to go. That makes sense. Of course, my broker hat goes on. Please also allow your brokerage a little bit of time to facilitate that. You can't just come in on your way to the closing and ask for a check. So your broker,
Right.
your bookkeeper will appreciate if you let them know in advance.
Right. The closing disclosure for the seller CD is up now, so you should see that on your screen. The right-hand side is going to be all the contact information, so your respective information should be included. The parties are recited, and once again, you'll see the sales price at the top with some details. The summary of the transactions is really where you're going to spend the time looking. And again, you'll see the numbers add up. You've got the sales price referenced here, and then you'll see the same reciprocal adjustment that we saw previously, where the seller is getting back a refund for the overpayment of the condo fee for the month of December because they don't own it the entire time. Same would be true for taxes or fuels. Now, section N is again sort of a summary of all the expenses. What's interesting about this is you'll see the itemization, and then you're just going to see the net bottom line at the bottom where this is truly what the seller will walk away with. But they don't have any idea what this little baby is right here. Closing costs paid at closing, $96.91. What's that? Well, it's on page 2. Okay. So I'm going to jump right to page 2 because that's where everybody wants to know, well, what are those details? And those are going to be the details about you guys, right? So that's where we're going to see some pretty basic fundamentals, the recording fees that are applicable, tax stamps required to be paid to the state of Rhode Island, $4.60 per thousand, commissions, and any kinds of administrative costs that they may have for their attorney doc prep, which would include in this case, the document preparation, a standard disbursement fee, which is basically the checks to be cut, and the courier fee to overnight their mortgage payoff. You can see a host of various different types of fees that attorneys will charge. And in the event that the closing cost credit wasn't lump summed, but was itemized, this is the area where you'd see the numbers. When you start seeing points up here, appraisal fee, credit report fee, that's where your spidey senses will go off. Why are we doing that? The prepaid section, the escrow section right here. If there's information in these sections, by and large, it's because the closing cost credit is now in an itemized format opposed to a lump sum format. And again, you will see the lump sum format is referenced right here with the settlement seller credit in section 8. Mortgage payoff, this is where you would customarily see payoffs. If the attorney was going to show the deposit right here in section 1, maybe where it is, although I've seen it down here in other open line items. Again, you just sort of have to understand the fundamentals is you've got the deposit at the office, you're looking for the balance. So long as the full commission is on the CD, it doesn't matter if it's cut up 6 ways to Sunday. As long as it sum totals your gross amount commission, you're good. And then you can see that we're paying for taxes. Those are also being prorated here, but that third quarter is still the seller's responsibility, as we had talked about at length on page 1, because they're on the buyer CD rather, because they're in arrears. The reimbursement for the resale certificate, in this particular instance, the agent actually paid for the resale certificate. I have a transaction going right now where there's over $8,000 in costs that the agent paid for the seller because the sellers were absentee sellers, they're out of state. So if that's the case, make sure you have an invoice together. Make sure you have an itemization of what those reimbursements are so that we can account for them properly. And then it's all factored into that bottom line proceeds.
This would also be the section if the seller were paying a contractor for repairs, that would be listed in this section as well, correct?
Absolutely. Yep. This is where any other line items would be for paid items.
And you as the closing attorney would cut the check to that contractor. In the example I used earlier, an electrician, you don't cut it to a party in the transaction, you make it out to the electrician. So a seller, can make a payment to a general contractor who can then sub out all of the work that needs to be done, or pay a specific contractor or entity.
Right.
Great.
And oftentimes the sellers are curious about their proceeds. They really need to be talking with their attorney or their closing attorney about how they're going to get the funds. They can either pick up a check or wire. I recently ran into an office where they have a no wire policy. They don't wire anymore. That was new to me. So make sure that you are having that communication with your respective clients in advance. Otherwise, we're going to have to do an about face, which is what we did. My client had to go pick up a check. She wasn't happy about it, but I'd never heard of an attorney not wiring before. So here we are. Dean, I know that I have a slide for the Alta in the PowerPoint, but it really doesn't say a whole heck of a lot. So maybe we should just jump into the Alta.
Yeah, let's look at, that'd be great. Because ultimately, and again, gang, this is the form that pulls it all together. Not all attorneys use it. It's not a required form. It just allows people to condense all of the details so that both parties have signed the same document. So go ahead.
So you are going to see on the buyer side, which is on the right, the debits and credits. Now I've been using debits and credits kind of intentionally and strategically throughout the course of today so that you can kind of get used to the idea. Credits reduce what the buyers owe. Debits are what the buyers owe.
And if I may, sorry, buyer, you're on the borrower side.
Borrower
Notice
side.
on the left is the seller side. I know that sounds silly, but I want to make sure that you cut the document down the middle. So seller is over on the left, buyer is over on the right.
You got it. And these are an itemization of everything that you saw on the CD. Now, again, you saw this particular closing disclosure, but you wouldn't normally. This may be the only document that as an agent you are going to have shared with you, which is customarily how we do it in my office. So you would see the purchase price. You would see the reimbursements to the sellers. You would see all the bank charges, more bank charges, escrows. These are all going to be reflected in the debits, which is what the buyers owe. Oh, I've got a crooked page.
Just everyone tilt your head.
Who's been drinking? It's only 10 a.m. You'll see the attorney's fees. You're going to see the recording fees. You know, again, these are all the same numbers that are on the buyer's CD, which the buyer should have. But as the agent, this may be the only place that you can look at them. And you'll see the, cutting working capital expenses for the condo fee, the prepaid condo fees that we talked about. And at the very bottom, you're going to see balance due from buyer. And it's this bottom line right here. Okay. So again, title insurance, homeowners insurance is all in there. Now this column, if you look, this is what they owe, but then we have to subtract out that credit that I just drew through. And those credits are just simply a sum total of the 4 credits that you see here on page 1, which is their deposit, their loan amount, their closing cost credit, and that municipal tax credit. So these are the credits that we looked at previously on the buyer CD. So I know you know what they are, but this is where those items would typically be housed.
Melissa, if I may, I also want to bring our languages together. It's
Sure.
a credit based on debits and credits on this sheet to show money
Yes.
paid versus monies received. It's
Yes.
not to be confused with a closing credit, which if we all get into the language of closing concession, then we won't ever confuse what credit is. So in a licensee's mind, we think credits between parties. I just want to make sure when you're looking at these are not credits from the seller to the buyer. These are
Right.
credits on this document. I know that sounds silly, but I want to make sure everybody's on the same page.
Yeah, and I'm using that language, Dean. The seller concession that's referenced here is referenced as a buyer credit because it reduces what the buyer owes.
Right.
But it's a debit on the seller side because it increases their expenses.
Right.
So I think it really just depends what side of the document you're looking at. But yeah, I agree. Using it as a seller concession to understand the difference is helpful.
Just for the purposes of the conversation here.
Sure. And this side of the transaction, the seller side, again, really basic, guys. You've got the sales price plus what's due back to the seller for the condo fee. That's your sum total of your credits. That's it. And that's what we saw at the top of the closing disclosure on the seller side, which generally speaking, the seller's closing disclosure is shared with everybody because there's nothing private there. Even their mortgage payoff is going to be on this Alta settlement statement. So that's why the closing disclosure for the seller side doesn't seem to be as confidential as that buyer's closing disclosure. Your debits, though, are all your expenses. So that's what we're talking about, that closing concession, the tax adjustment that you're seeing. If you were to keep going, you're going to see the commission. Now, Dean, this is important because there is an opportunity here where if the commissions were split out between the agencies and they're not even, it would be referenced.
Mhm.
I know initially when the closing disclosures all first came out, I think a lot of brokerages felt like, well, if we don't share it evenly, no one has to know the difference. They will kind of see it because it's right here in the CD, in the Alta rather.
And that's all good. At the end of the day, what we need to realize is that there is no requirement on how commissions are shared in the industry, right? So ultimately, a buyer's agent, when you're working with a buyer, you're offered compensation in MLS, and your compensation coming in, regardless of what the listing agent is charging the seller. So just to squash your concerns with that, and I appreciate that, and there is the controversy in the industry. We cannot pretend that there's not the controversy. Well, they're not sharing it equally. Please know that whatever compensation you feel is your value, you need to seek that from your client. So if you're on the buyer side, have a buyer's agreement so that you can truly be paid what you feel though the value of your services are. On the listing side, same thing. So, but to your point, it will be identified in this Alta, so you will see who's getting paid what, but really compensation is personal to the parties on their side of the transaction.
And one other side note is a lot of times buyer's agents, especially if it's a newer buyer's agent that doesn't realize if the commission is only shown as one item like this to one brokerage, that means that we as the closing attorney are not authorized to release the commission in two parts or two components. Because if the listing agent's commission reflected the two combined separate items, it would be referenced as one commission, two commissions to sum total that gross pursuant to your bill. And that would be the only time that as a buyer's agent, you can come to our office and pick up a commission check or ask us to mail it to you, because we don't have the ability to send that to you, which the listing agent hasn't authorized. So in this particular instance, you can see it was one commission bill right to the listing brokerage. They will pay the buyer's agents within the 10-day grace period that's allowed.
And there are times that a listing agency cannot pay a co-broke at closing. You know, if for some reason the escrow that the listing agency is holding has a portion of that co-broke's fee, it can't be done in disbursement. So it's not because a listing agency doesn't want to pay a co-broke, it's just that some of the funds might be on deposit. So when in doubt, have the conversation, colleague to colleague, will your office authorize me being paid at closing on the buyer side? What does that look like? Again, gang, this is your profession. We're professionals. It's okay to be asking the questions, especially as they relate to your brokerage fee. At the end of the day, you work hard to earn a living and we're on commission only income. It's okay to have that conversation. It doesn't make you look desperate. It makes you look professional because you're identifying where your income is going and how it's being received.
And maybe even just do it at the onset. So that way, you know what the expectations are as far as when the compensation is going to happen between the agents. It's not like you're dealing with it at the closing between the parties to try to make someone feel funny. And there are some brokerages that won't pay it out as of a policy decision, and that's okay too.
Right. And there's a policy in place even in the state with how many days maximum to get paid. At the end of the day, we all work really hard to make a living and we don't get a weekly paycheck. It's okay to navigate that process to understand the terms upon which you'll receive your check.
Payoff section, I just wanted to identify, this is where any mortgage payoffs would be. If you had a solar panel lien that was being paid off or an execution, any kinds of other type things, this is where it would likely be. This is where you see the tax stamps. So those are the transfer taxes that are due. And then again, you've got a couple of additional items referenced. This was for the third quarter taxes, which happened to be the seller's responsibility. You already saw the proration up top.
And if everyone notices, it's the same numbers that we saw on the CD. Literally, it's like shuffling a deck of cards and bringing it together back in one deck. It's literally just pulling it all together, and looking at it. So,
which is why I like this document, because it is one that can be shared with, more ease, less confidentiality, but I think it's more confusing because of the debits and credits and because of both sides being on one, it's harder to see.
Now, and I don't know at what point you are with this document, but ultimately it looks eerily similar to the HUD settlement statement. So
there is a HUD as you live and breathe.
So there are still closings, folks, that the HUD settlement statement is still used. So it really depends on the financing and the lender as to what type of closing, or closing statement is used.
Yep. So a HUD statement is primarily relegated to cash transactions. Commercial financing or hard money financing tends to be the three in which we would see a HUD statement. But you start to see the similarities of the HUD and the Alta Dean, because I think that's what American Land Title wanted to do, is recreate this old friend, right? That we all know and love. And I came out of law school with an accounting degree, and I looked at this thing and I said, I have no idea what this document is supposed to be telling me. So in some regards, I think the closing disclosures are easier to follow when you're looking at the buyer's versus the seller's version. I think for the layperson, they're easier to follow. I think the Alta settlement statement is confusing, but it's the only place where we have the combined information. The HUD is easier, but I think it's really just because we know it, And I'm going to just,
And ultimately, when we look at that, other than the flip side, borrower is on the left, seller is on the right. Literally, we don't need to spend a lot of time on this
right,
document. And I encourage, if anybody does have some lingering questions, post them, because, we're very mindful and we appreciate the questions. But, but ultimately, this is another form of closing statement. Is that what you said? Closing
settlement
documents?
statement, yeah.
Yeah. So, there are different formats that it comes in. And what I love about everything you broke down for us, Melissa, is, we've got the CD. It pertains to each side of the transaction. We looked at the buyer side, we looked at the seller side. That closing disclosure, CD, is specific to the party that it's drawn for. And then ultimately, we take the ALTA statement, and we combine both CDs with the information that is not confidential to either party, or
Exactly.
especially the buyer, I think more so. And
Right.
now, we bring that all together into an ALTA statement so everybody can see the debits and credits between parties. That is similar to the HUD settlement statement. So the reason I'm bringing that back home is, in the beginning, we talked about the different types of forms and what they are. And now we've just explained their usage and how they apply and how they correlate to each other. At the end of the day, it comes down to the type of transaction of the lender and or the closing attorney
Right.
as to which forms. Now, let me ask you, I have a question. Is this a true statement?
This
You
was a
ha-
cash transaction I closed on Friday.
Okay, no, I'm sorry, no, a true statement that I'm going to make, right? So
Oh,
you're talking realtor terms again. So ALTA statement, you can't have an ALTA statement without two CDs being involved in the transaction, right? Like, you wouldn't just
well,
do an ALTA instead of a buyer or seller CD.
there are attorneys who will do an ALTA. So I do an ALTA combined, but you actually can do an ALTA buyer and an ALTA seller. And again, you don't have the specific account information relative to the interest rate and the repayment terms and the loan account details, but you will have the debit and credit on the buyer side and the debit and credit on the seller side. And instead of it being all combined, you may end up with, Dean, when an agent's getting compensated, 4 or 5 pages of these settlement statements, buyer side versus seller side, to evidence this same transaction took place. So you can have an ALTA without a CD, and I guess a CD without an ALTA. It would, importing it from our side, we have to generate the CD to get to the ALTA, but there's lots of different systems out there. So different attorneys certainly could have a difference of opinion where they draft the ALTA first to back into the CD. Mine is just the flip side.
So, and breaking that down further, we have a question in the chat. So there will be an ALTA statement or a HUD, but never both, or ever both?
Never both, because an
Never both.
ALTA is typically reserved for finance transactions where you want to have a combined buyer and seller version. If you were in a cash transaction, the buyer and seller version would be combined on the HUD. So you wouldn't have an ALTA and a HUD. You'd have a CD and an ALTA usually.
Great. No, great question. Awesome. So generally speaking, Melissa, I'm gonna wrap this up and pull this all together. And again, gang, we have recorded this session, so it is available for review. We will have the link. So if we opened this up to all licensees throughout the state, so if anybody is interested in this recording, just please contact me directly. But Melissa, is there anything that we didn't hit on? We've got a few folks saying thank you in the chat box, so I want to make sure that you get the appreciation from everybody tuning in, Melissa, because
Well, thank
I
you.
really appreciate your time. But
I just wanted to show the commission on the HUD because I think that it is a little bit different. So you should be able to see it at the top of my screen here. And this is, I really like the way we do it in the HUD because it shows the full commission. Okay, so it's grossed up, but if you notice, it's not in the column as we reference. So
right.
it's just showing what it is. And then over here, you can see the breakdown that's going to be shared between the respective brokerages. And you see the deposit. So you see over here, it shows the deposit. So I always say it's a little bit of math, right? You take this $12,495 minus this $5,000 equals the balance of the commission.
It's a much simpler breakdown.
And back on page 1 is where you see that deposit referenced, not only on the seller side. So again, 5,000 plus This 74.95 brings you back to 12,495, but you'll also see the deposit on the buyer side. And that's, I think, the reason that we have such a difficulty conceptually of not seeing the deposit on the seller's CD, because we were used to it for years and years, I mean, decades, right? Where the deposit was on both sides. But to that end, it's a brave new world. And, you know, you get used to everything new.
Right. That's exactly right. And I want to mention in that example on the HUD, POC is paid outside of closing. So
Yes.
it's something that's accounted for, but not necessarily affects the you know, the figures
Right.
here.
And to that end, there is nothing illegal because there is no mortgage fraud. We can do absolutely anything we want on a HUD because it's a cash deal. There's no lender to give us constraints and parameters
Right.
of
And
what's allowed.
that's a good point. The constraints and the rules and the no credits and what can be credited all pertain to lenders, right?
Yeah.
So the type of financing affects that as well. You know, the less money a buyer's putting down, the more restrictions you're going to have on a loan. That's just the reality of it. You know, if you have a large down payment, the lender may have some flexibilities in that overall equation, but at the end of the day, it needs to be discussed with the lender.
Right.
Great.
Well, I think
Oh, awesome. Melissa, we've got
that's
some thanks
everything.
coming in. We've got some comments even in the chat, just, you know, saying thank you. I can't thank you enough. I appreciate it. I'm glad that this session evolved out of that conversation that we had. You know, when I gave your introduction of, was it 2004, you graduated?
Yes.
I'm proud to say that we have worked together since you've been licensed in the practice of law, because I worked with your dad before then. I remember you getting in the business, you know, 31 years later for myself. So, you know, I'm proud to say that we've worked together your entire career, and I appreciate that. So, and I just appreciate our ongoing relationship. So thank you for that. And thanks for making the time here today.
To help anybody, anytime, any questions. Our office really is here to try to exceed your expectations and do the very best we can for a smooth closing and transaction, especially during these challenging times. So thank you.
I want to clean out the questions as well. There is a question for your CE classes. Do you have a calendar of your courses that you run?
I don't have a calendar at present. They tend to be sort of an on-demand request for usually a brokerage where I'll go in and teach for the whole group. But right now, I haven't been teaching any CE classes in person. I know DBR was authorizing for online, but I did not structure my classes to be online. So at this point, I'm sort of at a standstill, I guess, with CE. And fortunately, we just went through renewal, so we don't have to worry about it for a little bit. But if we're all still relegated to mass, we're gonna have to figure out something real quick.
Well, and just so you know, there is a lot of conversation on a statewide level for CE credits to be available virtually moving forward. It's not approved yet, so don't quote me as we can do it all online now, but it really is close based on the current world climate. So you know, so that is something that's actively being worked on within the real estate.
That would be useful.
And you know, any of your courses that I can help with getting them approved or structured for virtual, I welcome the opportunity to co-host with you and bring them live. And you know, gang, we cannot do CE credits in a recorded version, you know, because you have to be part of it. But I welcome being part of getting any of those courses, because some people don't wait till the final month when you have to renew your license. So, you know, whatever we can do to, you know, create some opportunities for knowledge in the meantime, I'm all in. So,
and certainly, even if it may not be for CE, if there's an interest in any particular topic that would be useful to convert to a CE or do it as a conversation like this, I would welcome that opportunity, because I really do believe in the exchange of information. I think it genuinely makes for a much better experience, not only for us as the practitioners, but our clients.
Awesome. You know, and we've got some great comments again from folks. You know, for the recording, if you're interested in the recording, I can send you the link. My email is dean@leadingyouhome.com, all spelled out, leadingyouhome.com. Feel free to email me, and I can share that link with you. We can't post it publicly because this is a session for us as practitioners, so we're not putting it live on any YouTube channels, but we're absolutely glad to share it with you. And a few of the comments we're receiving, Melissa, is that, this was such a comprehensive approach to
Oh, good.
these documents. And I want to make sure you hear that feedback. So a lot of accolades, a lot of kudos, a lot of thank yous, but, especially, when we hear the comprehensiveness of the content that,
It's hard, as we talked about, Dean, without having anybody in person to say, like, is this going right? Is it going wrong? Should I abort mission and switch gears? So I'm glad to hear it. Thank you.
Yes, absolutely. There was a question about the new purchase and sales agreement. We won't go into that topic, but somebody asked, do you happen to have a cheat sheet with regard to your with the changes of the PNS? I know you mentioned you're doing a few courses for that. So, if anybody's interested on Melissa's cheat sheet, because she is working on some courses for some local brokerages, she works with many different firms. Feel free to email Melissa directly. And once that is pulled together, she'll be glad to share that. So, please email direct or email me, and we'll make sure that we hold her accountable to doing that. And Melissa, just so you know, I can help you with that because, I've got a lot of that content direct from the Forms Committee.
Perfect.
Okay, excellent. So thank you again, everyone, for tuning in. We appreciate you spending time with us. And Melissa, thank you again. I will see you very soon.
All right. Stay well, everybody.
Okay. Thanks. You too. Bye-bye.